G'day traders, Stacey Burke from Stacey Burke Trading today, focusing on one good trade per session. Now, we're going to do a quick review. I have gone over the daily charts, the weekly template, the daily template, the high and low of the day setups. We've talked about using smaller time frames at major round numbers at the high and the low of the day to maximize trade entries in terms of optimal fills. We've talked about looking for broken down markets for shorts for the easy money. We've talked about looking for trading longs in strong markets, the path of least resistance. Obviously, there's lots of different scenarios, and we'll just look at different cases of that, but most specifically looking for one good trade setup per day. I talked about 20 people sometimes are consumed with how many pips they can get, but if you can master some simple setups, it doesn't matter if they give you 25, 35, 75, 95. If you can get really good at mastering some simple setups, which happen inevitably, every single pair has at least one, usually one clean, super clean textbook 25 pip move every single day, and at least one of the sessions. So, among the six majors, a couple of crosses. I talk about gold, NASDAQ, and oil. Those are probably my three main trade setups, primarily because of the volatility. But again, I'm looking for trading, 1 hour a day. And there are some different scenarios and trade times where there are opportunities. But again, specifically, if I get that opportunity and I get 75, 100 pips, or 200 pips, oil can move 200 pips very quickly in 1 hour. I might call it a day because that's a pretty damn good trade, especially if you have size on it. I'm not necessarily consumed with trying to get as many trades as I can. That can sometimes be a recipe for disaster, especially if you're on a roll or you're overconfident or you just feel like, you can't, you're unstoppable. That can get you into some bad situations where you can end up going on tilt and doing damage and unwinding all of the great work that you have done. So a lot of the rules that I've put in place that I've pieced together over time are specifically geared at growing the account with scalable trade setups and making sure I'm not at the screen to do damage to undo that great work. So the less time I'm at the screen, maximize the time I'm there, maximize the trade setup opportunities, the importance of timing these entries, major round numbers, knowing, again, so I got an email the other day, how do you know when to hold on for a really big move? A really big move to me is based on time and distance. And so oftentimes if it's a scalp trade, it's 25 pips on a major pair. If I'm in gold, it could be 50, 75, 100. If it's a gap time trade or if it's a high day, low trade, it might be a 250 pip move. So that movement increment will be based on the time that it takes to get there with time decay. So that could mean we could be getting towards the end of an hour and it might have already moved 100 pips. That's probably the length of that trade setup for this particular impulsive wave. It could go another 100 an hour later, but I'm looking to take my money off the table and lock it in. So let's do a quick review. Asia, 8 to 11. London, 2 to 5 a.m. New York, 8 to 11 a.m. New York Eastern Standard Time. And specifically for London and New York, the equity market hour, the 3 a.m. to 4 a.m. and 9:30 to 10 o'clock, 10:30 area is roughly where I'm looking for my best trade setups if they have not occurred prior to that at the higher low of the day. So again, higher low of the day, high low of the month, high low of the week, high low of the session. So we are at the beginning of a new month right now, and we've had some low of the week trades. Okay, and again, when the week started, we had high of the week trades because we're inside at the high of the day. Even though we're inside the previous week, it's still the high of the week, the high of the month, high of the day, high of the session. So these are all relevant as the market begins its range expansion for the new month. Double zeros and 50s. Again, there's lots of videos on that. If you're not sure what I mean by that, I get this question all the time. What do you mean by double zeros and 50s? I'm talking about the price on the chart. Double zeros, 50s. Doesn't matter if it's an index. If it's oil, I could be working, like I'll look at this today. I put my chart readings at 250 pip increments. So I'm looking for major moves off of those market levels because the volatility is such that to trade in 25 pip increments can be, risky if you don't understand what you're doing. But when you're at the high or low of an hour in that London, New York time frame, then you're working at major quarterly levels, 250 pip boxes, but then also major round numbers, 50s, double zeros. You might go 25 pips above 50 to 75. But then that move proceeds back from major round numbers, and some of those, again, can go 200-300 pips. Engulfments, pin hammers. We talked about the M's and W's, final flags, 3-push patterns yesterday. Time compression, understanding time, and just recognizing on smaller time frames when they roll over into the bigger time frames. 1 hour, 15 minutes, 4 hour, daily levels, the importance of those time compression patterns when we are at highs and lows. Oops. So the pre-market, like that first hour to me often is the most important hour. If you're not already in an existing move, that first hour, I look for it to burst through a high or a low, whether that be a previous day's high or low or the existing daily high or low, because I want to see them trigger breakout traders. We could be in a trending day, and that doesn't matter. We'll look at an example of the Japanese yen. It was in a reversal day yesterday, one direction market. It still gave a very clean 25 pip trade towards the end of the 3-hour U.S. window. News, we have Fed tonight. We could see some major volatility, which again could lead to a second day trade setup. I don't want to get in front of that. Do I try and trade it? No, I'm usually in bed. I don't necessarily think it's necessary. There are plenty of quality trades without trying to take huge risk on with 50-50 situations. Again, when we come to the screen the next day, there could be a second trade entry. It might be a reversal setup. The cards will be on the table, and then there's opportunities to be seen. Then it's looking at the trade types, weekly template, scalp, reversal, breakout trade, trend trade, what they may be. Now, I look at the daily charts. We're at the beginning of the month. We could be in a reversal month. We could be in a trending month. We could be in a second leg continuation, or it could just be in a trading range. So again, we could be looking for false breaks at the tops or bottoms of a new month for a reversal. We talked about the psychology of trading, and we talked about making money. So if you can get good at mastering some simple setups that are scalable, you can grow those trades. You can, again, not focusing on how many pips can I get and being inconsistent and 100 this week and 10 next week and 30 today and none tomorrow. Focus on mastering some simple setups that show up every single session. Master those. Look for the best ones. Look for the ones that are going to be the least amount of stress. Don't try and trade every move, and then learn how to scale those up in size. Learn what your best ones are for increasing size, still controlling your risk, and look for the ones that are going to give you your home runs. The high of the month, level 3s, consolidations, major rectangles that will go for measured moves. And sometimes if it's high of the month, low of the month, you can see 700-800 pip moves. We saw gold move $10 in the last few days. That's 1,000 pips. So again, just for the purposes of demonstration, focusing on a couple of things. Timings, the timing window, the high and low of the day. We see that the Asian market in the euro rolled over, and this is before we get to our Europe window. The Europe window opens up and immediately goes down and hits the previous day's low. Now, again, we have a market that's broken down. It's pushed up, pushed up, pushed up. We have a smaller geometrical rectangle up top. I'm not even looking at numbers. We're just going to look at some basic concepts today. Breaks down, pulls back. This was a double zeros, breaks down and continues down. Again, remember, we have a low of the month in place, low of the week, low of the month. The market works back up before breaking down. It breaks down. That tells us it's making a new low. Breaks down again, pulls back, breaks down again, and at the end of our 3-hour window, it pulls back up inside of the previous day's low. What we have now is a new low. We have a new low. New low of the month, new low of the week, new low of the day. This is the low of the London session. This is the high of the London session. We have a box, a high and low of a box. We see the market has gone back up in the gap time, 1, 2, 3, pulled back, and hit the top of the London day, also into the breakout level from the Asian rectangle. So again, we have a high-low. The market's gone up to the high and dropped down, and proceeded to auction down in the U.S. session, hitting the low of the day, the low of the month, the low of the session. Now again, I've talked about using my 1-minute chart, and I look for these opportunities when I am at the extremes on the shorter time frames. Creeping trend that reverses on a squeeze at the low of the day, the low of the week, the low of the session for the explosive move back up. The difference between being in 25 to 50 pips for 3 hours and 25 to 50 pips in about half an hour. An example of a creeping trend blowing off in the direction of the creep is yesterday's gold trade. We see the market go up, put a peak formation 1, 2, 3 in place, drop down, pull back, continue into towards the end of the 12 candle window before dropping down and going vertical, basically 100 pips from top to bottom in about 10 minutes. So creeping trend that blows off in the direction of a trend. So we're looking at the British pound, and again, just an example, we had day 1, day 2, putting in new lows, creeper back up similar to the euro, and dropping down in the Asian session into the open of Europe. Europe goes down and puts a low in place. So we go through the previous day's low. That does not mean that we have a trade there. So some people are looking to buy and sell right at the previous day's low and high. I talk about the average stop hunt is 25 to 50 pips. This is a range extension at the low of a week. We're continuing to go lower. The market goes lower before dropping down again into the low at the London Open and then reversing on an engulfment. What that tells us now is that we may have a low in place. Now the market comes back up and the new hour starts, and we come down 1, 2, 3 into the low. So we have a low, we've locked it in. Now they revisit the low, which is where we get our 1 push, 2 pushes, 3 pushes down. That third push down pins into the low structures. Okay, we can put our low bull or low bear, whatever's at the low, as our boundary area if traders are looking to go long back up to the high of the day. So we have a low of the day and we have a high of the day. We have a triple bottom, or you can call a peak formation, and a shortened W. Say it's all the same thing. We have 25 pips below major round numbers. Again, if you're entering into this and you're looking for a 25 pip stop, thesis being that you want to get filled better than double zeros. Ideally, you want to be filled down in the bottom of this box. We're at the low of the week, the low of the month, the low of the day. This has the potential possibly for a measured move range expansion, which in this particular case it gave us. But we'll talk about, if I was in this trade, I would be merely looking for a move back to the high of the day. And the reason being is that because we're at the low of the month, low of the week, I'm expecting the market to revisit a level inside in the U.S. session. So again, coming back to some understanding that when you see the market accelerate or start to move before we get into the 12 candle window, they've brought you down lower into the open. You need to be suspicious that they're getting you to sell down low. They're getting you to sell down low, which should tell you something. This is possibly going to be a buy low setup. It's moving before you come to the screen. London is opening up down low. The London market opens up, the equity hour market opens up and takes traders back into the low for 15 minutes. False move session beginning. We get an engulfment, a 1, 2, 3 engulfment down at the low. That second 15-minute bar of London now breaks structure, comes up 25 pips, explodes up into the double zeros, and then proceeds to come back down. We talked about this yesterday. This is the lower high inside of our low of the day. So again, just looking at high-low possible profit targets, this lower high now becomes a possible geometrical structure for a measured move. So again, the market comes down. We'll blow this up into the low, locked in. London puts a low in, proceed to go up to double zeros and put a high in place. we're at the low of the month. We're expecting them to come back inside for the move back up. They come back 1 push, 2 pushes, 3 pushes, engulfment, and a bullpen hammer. The timing of this is at the end of the second 15-minute candle in the third hour. That's a 50 pip move. Fill is roughly 85 with the spread. Market comes up to 10, so a 25 pip move in 3 minutes. That's, again, the creeping trend down. A low of the day, low of the session, low of the month, and the squeeze down at the bottom. And our measured move does a full range expansion before we get to the U.S. Of course, obviously later it fulfilled that, but again, just taking one full expansion during that London session would be a reasonable profit target for people to take. I wanted to just look at the yen and give an example of where a market has, they split the Asian box. So we have an example of where the market puts in a high in Asia, they drop it down and put a peak formation in, and then rise above it and layer on top of that. I talked about this in a couple of videos. Whenever you see that, that's endemic of a trend trading day. That's a measured move pattern. So we have a market that's reversed on the yen and trending up in the upward direction. Hugging this trend line. I am not worried about technical perfection. I'm talking about a market that's definitely respecting an upward direction. So we have a market that continues to rise during the U.S. session. So every session has an opportunity. Now, in this particular situation, we have a market that has a high of the day, and we have a market that comes down into the previous day's high and locks in a low. So this is different than a market that does a pump and dump. This is again a trend trading example. We have a consolidation. The market breaks out, layers on top. But even when we get a market that's trending strongly, we still have an opportunity for a trade. So the market, you might be long. So you could go long here and you're long. And again, the difference between a long creeping trend that lots of order flow when it's very slow and working back and forth inside of a range, be suspicious that this volume isn't going to end up becoming low-hanging fruit. The market works its way up to 50 and puts a high in place, pulls back, hits it again, comes down and breaks structure, comes back 1, 2, 3, pin at 50 for the short trade, back down into the open of the session for 25 pips, back down fast and furious. So again, even in a trending market, you can get these creeping trends pushing up, pumps it up. So there's a pump up, a pump and dump on the last leg of the trade. If you're not sure what the pump and dump is, go back and look at some of my other videos. It's everywhere. We see this little pin on the last leg of the trade, this little pin hammer, and the market proceeds to push its way up into 50, breaks the high, locks it in, breaks structure, makes a lower low, and then comes back up one more time, pins into the high again at the beginning of the third hour. 1 hour up, 1 hour continued trapping volume up high, locking in the high. Then the next hour comes up, revisits and stop hunts the high before dropping down and blowing off vertical into the low of the session. And again, ADP was in here, right here with the pin, so again it was pretty inconsequential to the yen. And I wanted to talk about oil. So the process is the same. Every single market, every single session is the same. I want to know where's the high and the low. In this particular situation, oil broke out of the previous day's high right off the bat in Asia and put in a new high of the day. It continued to auction higher at the end of the Asian session, pushed even higher through that high, giving us a pin hammer. I'll blow this up. A pin hammer right at the London open. So the next hour opened at London and proceeded to drop down and pull back again. So not selling the high, locking in the high, pulling back and looking for the sell for the move back down. That's the safety trade. Not getting in front of a steam train, a runaway market. We're waiting for them to lock in the high, and this is again on a longer time frame. This is a 15-minute chart. And then there's our gap time. So we're not going to go into depth on that, but the gap time trade is very specific to the time of day. They come down, they lock in the low, and they reverse and start to move back up. There's the beginning of our pump and dump into the high, our pin hammer on the 15-minute chart. They proceed back up to the high of the day, locking it in, retesting it in that third 15-minute bar, so 45 minutes to the high of the day. And again, on a 1-minute chart, they locked this in at 50 at the high. And then this market proceeded to drop down from high to low 600 pips back to the breakout trade. Now, the candle that broke through the previous day's high had a gap to where the breakout trader had not been stopped out yet. And that's a great sign on a big moving market. You want to talk about risk reward. On the 1-minute chart, there was a 25 pip stop up here for an entry of anywhere from 400 to 600 pips back down, depending on where you targeted that trade. So they broke through the high, which means the high from the previous day is there. They got end-of-day traders in, 4-hour, 1 hour, whatever, breakout traders. They're all in the market. But it just means that the high isn't complete yet for this cycle, for this week, for this day. They pull it back. There's a gap time trade in Asia, going back to the high of the day into the open of the Europe session. Europe first hour takes it higher. They lock in a high. London comes back and stop hunts back down a couple hundred pips before locking in the low in the gap time and starting the march back up to the high of the day, locking in the high, and then free falling into the low of the day before consolidating at the low for you North American traders at the end of the 3-hour window. So an example of where the 3-hour window trades, they lock in the low and proceed to continue the long trade back up. So even in a strongly trending market, so coming back and looking at this, in the last 3 days, this market's moved almost $15, so $13, $14, which is 1,400 pips. So you can still get some tight risk-reward opportunities. This is a 20, 30 to 1 trade setup from top to bottom. Definitely 10 to 1. So be patient. Look for the best opportunities. There is a good trade, at least one great trade every session on one of these pairs. Keep it simple. Stay disciplined. Stay focused. Stay out of the junk on the inside. Wait for the best opportunities. And may the markets go.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.